Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening the economy. And Phil, this feels like the calm before the earnings storm, particularly with analysts taking down their Q2 forecasts significantly.
Yeah, I mean, you'd expect the analysts would have taken down their forecasts, and that's probably a good point to note because we know that the businesses have been shut down. A lot of companies have been, seeing a big reduction in revenues and sales. Like all of that data, we already know. So the analysts have already priced in a pretty bad quarter. But what's interesting is a lot of companies have stopped giving guidance because they just don't have a clue themselves about how recovery is going to fare against a vaccine success, against the stimulus. And there's such big numbers of stimulus and such a dramatic outcome if we find a vaccine in 3 months versus 9 months versus not at all. So the analysts' expectations have actually broadened as well because the companies aren't helping the analysts and the analysts have no real idea with all the uncertainty in the market. So you're right, we could have a calm before the storm because there could be some numbers that come out that are way better than expectations or potentially way worse, especially like we kind of know the earnings are going to be more impacted in some of the discretionary spend categories, tourism, leisure, less impacted and maybe actually beating in online retail and groceries. So that's all priced in as well. But we'll find out company by company how they're dealing with those sorts of challenges. And we could see some movement in single companies and obviously in the whole market too.
Let's take a look at our next couple of charts here, New York Fed and U.S. spending, because the economic data tells a very different story than what we're seeing take place in the stock market.
Yeah, I mean, the stock market's back pretty close to the start of the year levels for a lot of large cap indexes. The Nasdaq 100 is obviously up 20+% because it's got a whole lot of companies that are really well positioned for coronavirus, like Netflix, like Amazon, like Zoom. But in reality, the data is still pretty poor. And I think that's one reason why the analysts' expectations of earnings are still pretty low as well. So the New York Fed collects daily data and tries to work out from that data what the GDP is going to be. And you can see from back-tested data, it's a pretty decent forecaster, although obviously this is a pretty extreme test for that forecast too. But right now, we've seen a bounce. We've seen it come back from 12% down to 8% down. But that's still down a lot. It's a big drawdown for any recession. And if you look at the consumer spending, it sort of supports that story as well. As we saw the massive drawdown in March, we've seen a recovery in spending. The red line is low income spending. So a lot of people on lower incomes have less discretionary cash. They're back to spending now, only just now, pretty close to normal levels. But on average, most Americans are still keeping cash in their pockets. And so revenues are bound to be down. We kind of know that. And I think that the expectation is just how bad is the quarter going to be. And the real point, because stocks are forward looking, is what's the expectation for Q3, Q4, and next year and a vaccine.
All right, and our final chart of the day here, taking a look at bankruptcies, we are pretty much so on pace to what 2009 looked like, and we know what happened then.
Exactly. And I remember last quarter, a lot of the banks had some pretty decent provisioning. It was almost out of step with the sort of drawdowns that we saw from the companies. And I guess that was because a lot of companies back in Q1 had only seen 2 weeks worth of shutdown. But we now know, and we've talked about it recently, lots of brand name retail, Chesapeake, have filed for bankruptcy. So credit is definitely a concern for banks. We saw even this morning some big provisioning, about $30 billion added to the provisions from last time by the banks for credit losses. And so, that's important. And it does signal the fact that there are more downstream classic recession type risks to what's going on and the lack of employment and just the credit exposures of companies and their going concern, offsetting the confidence of the stock market and the chance of a vaccine and all this stimulus.
All right, Phil, thanks for joining us as always on Trade Talks.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.